Hey folks, David Frost, LazyGapTrader.com. In this video, we're talking about day trading, but more specifically, we're talking about gap trading and how gap trading is by far the single most consistent and profitable day trading strategy you can find across the markets today. In this video, we're going to do something a little bit different. I'm actually going to try and teach something that relates specifically to day trading, but relates more specifically to gap trading. And I think it's going to be to benefit anybody that's taken my course on gap trading. There was a couple of trades today that I think we can have some positive takeaways from. Sometimes, whether we win or we lose a trade, if we can take away a positive learning experience that we can apply to a future trade, then regardless of whether or not we made money, broke even, or lost money on the trade, if it's something that benefits us later, it's a win no matter what. So before we get into the charts, I just want to make clear what I'm doing. I do two things. I teach a course at LazyGapTrader.com on gap trading strategies. Within the course, there are two specific gap trading strategies taught. One is known as the morning gap trades, and the second are gap fill trades. The morning gap trades are when stocks are gapping significantly higher or lower at the opening bell from where they closed the prior trading day. It creates an opportunity for traders that can identify a specific price where that stock should have a price reaction in the other direction. A, the stocks are generally drawn to these areas, and B, they have price reactions in the other direction at these price areas. In my course, I teach traders how much a stock has to be gapping down to qualify. What type of stocks do we play? How do you calculate those price levels? Everything you need to know is contained in the lessons in the video-based course at LazyGapTrader.com. The second strategy taught is the gap fill strategy. Whenever stocks gap higher or lower at the open, it's called leaving an open gap. At some point in time, the stocks will come back to fill those open gaps, at which time they may create a tradable opportunity. In the course, I explain which ones create a tradable opportunity. How do you identify the tradable opportunity? When to take a trade, when not to take a trade? Where exactly is the gap filled to the penny? All that information and much more is contained in that portion of the gap trading course, gap fill trades. All right, let's move on. The other thing I do is I offer to traders that want to get them my gap trades each and every day. They get an email at 9 o'clock a.m. Eastern Standard Time, 30 minutes before the opening bell. This happens to be a copy of the email, Lazy Gap Trader, and as you can see, we had about 7 potential gap trades on the board today. Unfortunately, only 2 hit their levels, 5 did not. When a stock does not hit its level, it's a no trade. But some days we have more than others. Yesterday we had 6 total trades. Today so far we had 2 off this list. The ones that hit their levels were American Airlines. I say gap lower, support levels are 43.30 and 42.33. Remember those numbers. Stop and profit target is about 25 to 45 cents. The other stock that hit its level today was Mellanox Technologies. Gap lower, support levels are 42.26, and I give a secondary level. Stop and profit target is about 25 to 45 cents. Now keep in mind, these are minimum profit targets, but we're going to learn something on these 2 specific trades that anybody can utilize. So first, we're back on the chart of Mellanox, and you can see here the 42.26 level running across the bottom portion of the screen. The stock pierced through it, making a low of 41.55. Now, the reason why I wanted to bring this to your attention is because the low of the stock today happens to be a little bit wider than the recommended stop loss limitation. And in the email that goes out to subscribers, it says about 25 to 45 cents or whatever the stop on each stock happens to be. Now that means it could be 50 cents, it could be 55 cents. It depends on the individual trader. However, I do realize that some traders were stopped out of this stock today, and look what happened. It found a low slightly below our level, and it ripped higher, making a high thus far today, and it's not done yet, of $45.95. So here's what I wanted to discuss about this stock. Couple of things. A, you can see the power of these price levels. Even though the stock went a few cents lower than the recommended stop loss limitation, look what happened. You can see the power of these price levels. Sometimes we get these stocks that end up going up $2, $3, $4, $5. Doesn't happen every day, but it does happen. And in the course, I teach you how to take advantage of situations like this, where you can turn some of these trades into risk-free, emotionless trades. But the point I wanted to bring up is, in the course, I specifically discuss the type of volume and the type of stocks we're looking for on these gap trades. And this stock qualified, but it happened to be on the lower end of the spectrum in terms of the minimum recommended volume that stocks should have in order to qualify for the gap trades that we want to see. And what you can see here, and this is the lesson or the takeaway, is that the lighter the volume, the more prone the stocks may be to pierce through their levels by a little bit more than some of the much higher volume stocks, for example. Some of the much higher volume stocks will have a tendency to respect their levels much, much closer to the exact number. The lighter the volume stock, and especially when on a day when there's a gap up or down, the volume spikes up, and therefore the stocks can go a little bit farther than we think in either direction. And that's a case of what we saw today in Mellanox. So that's a valuable takeaway. The next time we're trading a stock that has lower volume than some of the big heavyweights out there, we just want to understand and pay attention to the fact we might want to give the stock a slightly larger stop just to give it a little more wiggle room. That's it. Let's take a look at the next one, because there's another lesson in the next stock. Here we're on the daily chart of American Airlines, AAL, and you can see the two levels that were issued this morning, 43.30 and 42.33. The stock did trade through its first level. It's trading around that level as we speak, but it did trade through there earlier today. And here's the lesson that I want to bring to the forefront. I do get asked quite a bit, what happens when price levels we calculate are close together? Should we exit the trade, take a loss if it trades through, and then rebuy at the second level, and then I'm too afraid to buy? And that's a common occurrence with traders. Even if they have a secondary price level, they end up being gun shy. One thing I want to bring out is the two price levels are mutually independent or exclusive of each other. They're two separate trades. Each price level has the same odds as the other price level of having the same type of bounce we're looking for. So even if we took a trade and it turned out bad, the second price level should not preclude us from taking the second trade. Let me point something out. Let me move the chart over, and what you can see is the second price level came up short, or the stock came up short. The low was 42.41. The second price level was 42.33. So we never did hit it, and the stock bounced back towards the first level at 43.30. But here's the lesson that I wanted to point out. When price levels are close together, one method that I tell traders when they ask is you can buy a portion of a position at the first price level. If the stock continues down and moves through the first price level, knowing there's a safety net of the second price level not far away, you can add to it either just in front of or at the second price level, averaging down the cost, as long as you're comfortable that you should get a bounce at the secondary price level. Then there's no reason to believe that we shouldn't in American Airlines, and we did, we just never got exactly to the second price level. But that's one way to trade the stocks when the price levels we calculate, as taught in the course, come out close together. When they're close enough, in this case $1 away, that's one of those situations where I'm okay with buying half a position and waiting just in case. If the stock takes a rocket off the first price level and continues higher right away, I still have half a position, or half the intended shares that it would have originally bought. It's still a profit nonetheless. So you can't really lose doing that as compared to buying the whole position at the first price level. So it's a way to mitigate risk, and for every way that we mitigate risk, we have to give something up on the other side. So what we give up in this case is the potential for the gain on the full position if we bounce higher immediately at the first price level of 43.30 in this example. So I thought those were two valuable lessons, something to take away from two trades today. I'm David Frost, LazyGapTrader.com. If you want to learn more about trading, if you want to learn more about gap trading, I'm always happy to answer questions. No question ever goes unanswered in my book. Thanks for tuning in, folks. I'm David Frost, LazyGapTrader.com.